$2 trillion vanished in a single day. October 10, 2025 will go down in history as the day Trump dropped a tariff bomb that sent shockwaves through Wall Street. At exactly 10:57 a.m. Eastern Time, Trump posted on Truth Social threatening 100% tariffs on all Chinese imports starting November 1st. The market's reaction was immediate and brutal. The Nasdaq crashed 3.56%, the S&P 500 plunged 2.7%, and the Dow Jones dropped 878 points. Tech investors watched in horror as their portfolios turned red. But here's what most people missed while they were panicking. Trump accidentally handed dividend investors the opportunity of a lifetime. While everyone else was selling in fear, I was buying. And by the end of this video, you'll understand exactly why this market chaos is actually a massive gift for income investors, and which stocks I'm personally loading up on right now. Let me take you back to that chaotic day and explain what really happened. Trump's escalating trade war with China reached a fever pitch in early October 2025 when China's Communist Party announced unexpected export controls on critical rare earth minerals vital to our technology and defense industries. Trump's response was swift and severe. He threatened to impose 100% tariffs on all Chinese imports, which would raise the effective tariff rate to a staggering 130%. He also slapped export controls on any and all critical software and initially canceled his planned meeting with President Xi Jinping. When that Truth Social post hit at 10:57 a.m., the market went into freefall. By closing bell, approximately $2 trillion in market capitalization had evaporated according to Bespoke Investment Group. It marked the biggest single-day decline since April 10th for both the S&P 500 and the Nasdaq. Financial analysts were repricing assets across every sector, and investors were reallocating portfolios away from the United States at a pace we hadn't seen in years. Even the US dollar depreciated against safe haven currencies like the Swiss franc, Japanese yen, and euro. But here's where the story gets interesting and where Trump's gift to dividend investors becomes crystal clear. While mega-cap technology stocks were getting absolutely crushed on fears of semiconductor supply chain disruptions and lost access to Chinese markets, something remarkable was happening with defensive dividend stocks. They were holding their ground. In fact, several big names like McDonald's and Johnson & Johnson actually performed quite well in response to the news. This wasn't random luck. This was a fundamental shift in investor sentiment, a massive rotation from overvalued growth stocks into undervalued dividend-paying machines. For the past 2 years, the Magnificent Seven tech stocks had driven the market to new heights. But the tide started turning in 2025, with sectors like financial services, energy, and industrials beginning to outperform those high-growth technology names. The October tariff shock accelerated this rotation dramatically. Investors fled from stocks with sky-high valuations, complex global supply chains, and heavy exposure to Chinese manufacturing. Instead, they sought refuge in companies with predictable cash flows, domestic business models, rock-solid balance sheets, and most importantly, steady dividend payments. Now, let me explain why defensive dividend stocks outperformed during this sell-off, because understanding this is key to capitalizing on the opportunity. First, these companies operate in recession-resistant industries. They provide essential goods and services like food, beverages, healthcare, and utilities that consumers need regardless of economic conditions. Their business models are largely insulated from tariff impacts because they either source and sell domestically or operate in service sectors that are completely exempt from trade restrictions. Second, Dividend Aristocrats and Dividend Kings, those elite companies with 25+ and 50+ consecutive years of dividend increases, have proven track records navigating multiple recessions, energy crises, and geopolitical shocks while continuing to raise their payouts. This historical resilience provides confidence during uncertain times. Third, the Dividend Aristocrats Index has delivered steady annual dividend growth of 6% over the last decade, with significantly lower volatility than the broader market. While aristocrats have slightly underperformed the increasingly tech-heavy S&P 500 in recent bull market years, they exhibit dramatically lower risk as measured by standard deviation. And during periods of market stress like we're experiencing right now, that lower volatility becomes incredibly valuable. This brings us to the three-dimensional opportunity Trump has created for dividend investors. The first dimension is what I call the flight to safety premium. When markets panic, both institutional and retail investors rotate into quality dividend payers with recession-resistant characteristics. This creates buying pressure that can actually drive prices higher, even as the broader market declines. The Dividend Aristocrats represent the gold standard here. As of 2025, there are 69 companies in this elite group spanning 10 sectors with notable concentrations in consumer staples and industrials. In September 2025, 55 of these 69 aristocrats had already raised their dividends at an average rate of 5.19%, demonstrating continued commitment to shareholder returns despite economic uncertainty. During the October sell-off, several aristocrats demonstrated their defensive qualities beautifully. Companies like Procter & Gamble, Coca-Cola, PepsiCo, and 3M held up relatively well as investors sought stability. These boring businesses aren't likely to generate 20% earnings growth, but they're also very unlikely to see large earnings drawdowns, and that's exactly what nervous investors want right now. Let me highlight some top dividend aristocrats for October 2025. Clorox offers a 4% yield with 48 consecutive years of dividend increases. S&P Global boasts an incredible 52 consecutive years of increases. Automatic data processing brings strong payroll processing fundamentals to the table, and Brown & Brown operates in the insurance sector with decades of proven dividend reliability. Each of these offers a combination of defensive business models, reasonable valuations, and rock-solid dividend track records. But here's where things get really interesting for the average investor. The Schwab U.S. Dividend Equity ETF, ticker SCHD, has become one of the most widely held income-focused ETFs with approximately $60 to $69 billion in assets under management. SCHD tracks the Dow Jones U.S. Dividend 100 Index and holds a concentrated portfolio of high-quality, cash-generating companies with strong records of dividend sustainability. Now, I'll be honest with you, SCHD has faced headwinds in 2025, returning just 0.87% year-to-date with dividends reinvested as of October 17th, or essentially flat at 0.05% without reinvestment. But this modest performance must be viewed in context. The fund's quality-focused, value-oriented approach has lagged during the tech-dominated bull market of early 2025, but it has demonstrated its defensive characteristics during volatility. Here's what most people don't understand about SCHD. During the severe market crashes of early April 2025, when tariff fears first emerged, SCHD experienced gap-down days on April 3rd, 4th, 7th, and 10th. But then something remarkable happened. The fund rebounded with a stunning 6.4% gain on April 9th as investors rotated into defensive stocks. This exact pattern is repeating in October. While SCHD couldn't avoid the initial October 10th sell-off, the fund's holdings of quality dividend payers positioned it to outperform as the flight to safety intensified. With an expense ratio of just 0.06%, and a trailing dividend yield of 3.88%, SCHD remains one of the most cost-efficient and income-reliable ETFs available. The fund has maintained a 5-year dividend compound annual growth rate of 12.2%, with total distributions reaching $3.27 per share in 2024. Over 10 years, SCHD has delivered an impressive 11.8% compound annual growth rate with dividend reinvestment, turning $10,000 into $43,584, a total return of 335.8%. Top holdings include Broadcom, Home Depot, Texas Instruments, Pfizer, and PepsiCo. Analysts at Morningstar recently reiterated a gold rating for SCHD, emphasizing its consistency and investor-friendly structure, stating that SCHD offers a rare blend of quality, yield, and cost efficiency that continues to outperform across full market cycles. Now let's move to the second and arguably more lucrative dimension of Trump's gift, the irrational sell-off bargains. These are high-quality dividend stocks with minimal actual tariff exposure that got caught in the market-wide panic. These companies offer the potential to buy the dip and capture both attractive yields and capital appreciation as prices recover. Energy infrastructure companies, particularly midstream operators, represent some of the most compelling opportunities created by the tariff volatility. These businesses are largely exempt from direct tariff impacts because oil and gas are not subject to Trump's trade restrictions. Moreover, their business models are based on long-term, fee-based contracts for transporting and storing energy commodities, making their cash flows highly predictable and recession-resistant. Enterprise Products Partners, ticker EPD, is one of the premier names in this space, offering a dividend yield of approximately 7.21%. EPD operates one of the largest and most diversified midstream energy networks in North America with extensive pipeline systems for natural gas liquids, crude oil, and petrochemicals. The company has increased its distribution for 25-plus consecutive years, earning Dividend Aristocrat status among the rare master limited partnerships to achieve this distinction. EPD's MLP structure provides tax advantages as distributions are considered return of capital rather than ordinary dividends, deferring tax liability. The company maintains a strong balance sheet with investment-grade credit ratings and a conservative distribution coverage ratio, ensuring sustainability even during energy price volatility. With a current stock price providing a 7%+ yield and minimal tariff exposure, EPD represents a compelling opportunity for income-focused investors. ONEOK, ticker OKE, is another leading midstream operator focused on natural gas pipelines and processing. In Morningstar's October 2025 list of the 10 best dividend stocks to buy, OKE is the highest-yielding name, offering a 4.82% yield while trading 16% below fair value estimates. OKE benefits from long-term fee-based contracts that generate stable cash flows regardless of commodity price fluctuations. Several recent acquisitions made at favorable prices have set up ONEOK for growth in 2025 and 2026, with analysts expecting the company to raise dividends at a consistent 4% to 6% rate. Then there's Enbridge, ticker ENB, which stands out with its 70-year dividend payment history and 30 consecutive years of dividend growth, yielding approximately 5.66 to 5.68%. In December 2024, Enbridge announced a 3% increase to its dividend per share, raising the quarterly dividend to 94.25 cents, translating to $3.77 per share annualized for 2025. Over the past 30 years, the dividend has grown at an average compound annual growth rate of 9%. What makes Enbridge particularly attractive is that 80% of its EBITDA stems from assets that either have revenue adjustments or regulatory frameworks to recoup cost increases, providing stability in earnings. The company's dividend payout ratio is expected to remain within its target range of 60 to 70% of distributable cash flow, providing a healthy balance between returning income to shareholders and retaining income for reinvestment. Enbridge is uniquely positioned to benefit from AI-driven energy demand surges. With data centers and AI infrastructure requiring massive amounts of electricity, natural gas demand for power generation is expected to grow substantially. Recent AI news and Federal Reserve rate cuts are viewed as very bullish for energy infrastructure companies like Enbridge. The company maintains an A- credit rating and strong balance sheet, insulating it from interest rate pressures. Analysts at multiple firms have reiterated buy ratings on ENB with price targets suggesting 29% upside potential. Recent analysis notes that falling interest rates enhance ENB's dividend appeal and margin outlook, supporting a 5.64% yield and continued annual dividend growth. Business development companies represent another category of high-yielding dividend stocks that were irrationally sold off during the October volatility. These companies provide debt and equity financing to middle-market businesses, typically offering dividend yields of 8% to 18%. BDCs are required by law to distribute at least 90% of their taxable income as dividends, making them reliable income generators. However, they're sensitive to recession fears and interest rate expectations, causing them to sell off sharply when economic anxiety spikes. Main Street Capital, ticker MAIN, is widely considered one of the best managed BDCs, offering a base dividend yield of approximately 5.2% plus regular supplemental dividends that have historically boosted total yields to around 7%. MAIN provides debt and equity financing to lower middle market companies with annual revenues between $10 million and $150 million. Main Street's strategy of keeping its regular dividend modest while topping it off with special dividends twice per year provides flexibility during economic downturns while maximizing shareholder returns during good times. The company has raised its monthly dividend twice in the past year and declared supplemental dividends of 30 cents per share quarterly. At the end of Q1 2025, Main Street had interest in 86 lower middle market companies valued at $2.6 billion. 13 middle-market companies worth $128 million, and 90 private loan investments totaling $1.9 billion. The BDC generated net investment income per share of $1.01 in Q1 2025, with distributable net investment income per share of $1.07. Net asset value per share increased 1.2% to $32.03. Demonstrating solid portfolio performance. Blue Owl Capital Corporation, ticker OBDC, offers a more aggressive yield of approximately 10.2%. The company invests in and lends funds to U.S. middle-market companies generating annual EBITDA between $10 million and $250 million, generating around $1.6 billion in gross investment income annually. In Q1 2025, Blue Owl achieved gross investment income of $464.6 million, up 16.7% year-over-year, and net investment income of $201.3 million, up 10.1%. The company declared a base dividend of 37 cents plus supplemental dividends of 1 cent, with total dividends equaling $1.72 in the prior year. The BDC is very well diversified, with its top 10 positions accounting for roughly a fifth of its total portfolio. Importantly, 77% of Blue Owl's portfolio consists of first-lien loans, with another 5% in second-lien loans, and fully 97% of its debt investments are floating rate. This positioning protects the portfolio from credit losses and allows it to benefit from higher interest rates. Software is its largest industry exposure at 11% of the portfolio, followed by insurance and healthcare at 8% each. Other high-yielding BDCs worth considering include Ares Capital, ticker ARCC, with an 8.9% yield and conservative allocation with 59% in first-lien loans and 6% in second-lien loans, and Gladstone Capital, ticker GLAD, yielding 6.9%. These companies saw sell-offs during the October tariff panic despite having business models largely insulated from trade policy impacts. Real estate investment trusts represent another sector offering compelling opportunities after being caught in the tariff sell-off. Many REITs pay monthly dividends rather than quarterly, providing smoother cash flow for investors. Realty Income Corporation, ticker O, known as the Monthly Dividend Company, yields approximately 5.8% and has a long track record of monthly dividend payments. The company owns over 13,000 properties leased to commercial clients across retail, industrial, and other sectors under long-term net lease agreements. This structure passes operating expenses to tenants and provides predictable cash flows. Recent analysis notes that up to $1.3 billion in institutional capital flowed into Realty Income shares as of Q2 2025, with stability being the primary attraction. The company raised $104.6 million by issuing common shares and maintained its dividend at 72 cents per share for the quarter. The dividend yield of 5.8% beats both the 10-year Treasury yield and the net inflation rate, making it attractive in any business cycle. Stifel Nicholas analyst Simon Yarmack reiterated a buy rating for Realty Income with a price target of $68 per share, implying 22.5% upside potential. The REIT's relative immunity to trade tariffs, given its domestic retail property focus, makes it particularly attractive during tariff volatility. Mortgage REITs offer even higher yields, though, with commensurately higher risk. ARMOR Residential REIT, ticker ARR, yields approximately 19.4%, while Orchid Island Capital, ticker ORC, offers a 20.5% yield. These mortgage REITs invest primarily in agency mortgage-backed securities guaranteed by government-sponsored enterprises, providing some downside protection. However, mortgage REITs are highly sensitive to interest rate movements and credit spreads, making them volatile. These ultra-high yields should be approached cautiously as they reflect genuine risks, but for investors seeking maximum current income and willing to accept volatility, the post-tariff sell-off may have created attractive entry points. The third dimension of Trump's gift is the opportunity to invest in sectors that will directly benefit from his policy agenda, including tariffs, deregulation, and domestic production incentives. Companies with domestic production and minimal import dependence stand to benefit from tariffs that make foreign competitors more expensive. The J.M. Smucker Company, ticker SJM, commands only 1.2% of the U.S. jam and jelly industry, but nearly 25% of all U.S. jam and jelly products are imported. If J.M. Smucker can capture even 1% of this gap as tariffs make imports more expensive, it would represent approximately 3% in annualized revenue growth relative to fiscal 2025 forecasts. SJM's dividend yield exceeds 3.6% with the payout safe at roughly 50% of earnings. The company is expected to continue growing in fiscal 2026, sufficient to sustain its distribution increase trend, which includes 24 years of annual increases and a 5% distribution compound annual growth rate over the last 5 years. Verizon, ticker VZ, represents another domestically focused opportunity with a 6.2% dividend yield. Verizon's internationally operating business is relatively insulated from tariffs because there aren't any tariffs on services. Even its locally operated businesses abroad are unlikely to be significantly impacted. The stock trades at only 10 times earnings and shows bullish characteristics. Trump's agenda of deregulation and energy infrastructure development creates tailwinds for energy companies and utilities. Energy companies stand to gain from streamlined permitting processes and reduced environmental regulations, while utilities benefit from predictable regulated earnings and infrastructure investment needs. The Utilities Select Sector, SPDR ETF, ticker XLU, provides diversified exposure to regulated utility companies yielding 3% to 4%. Utilities typically show lower volatility and appeal to investors seeking stability. Companies in this sector often have pricing power through regulated rate-setting mechanisms, allowing them to pass through inflation and maintain profit margins. Consolidated Edison and other regional utilities represent recession-proof investments with dividend yields around 3% to 4%. From strengthening the grid to participating in the clean energy transition with efficiency projects and electric vehicle charging stations, these companies enjoy predictable earnings and secure dividends in all economic environments. Alternative asset managers like Blackstone, Brookfield Asset Management, and Brookfield Corporation offer exposure to diversified alternative investments while providing dividend income. These companies benefit from capital deployment opportunities during market dislocations and typically have flexible business models that perform across economic cycles. Among traditional defensive dividend stocks highlighted for October 2025, PepsiCo stands out as a dividend aristocrat with a 4.19% yield, trading 19% below Morningstar's $162 fair value estimate. Despite near-term headwinds from consumer belt-tightening in the U.S. and higher supply chain costs, Pepsi remains poised to bolster its competitive standing in beverages and snacks by leveraging marketing and product initiatives. Over the next decade, Morningstar expects Pepsi's payout ratio to remain in the low 70s on average, and the dividend payment to grow at a mid-single-digit pace annually. Schlumberger, ticker SLB, appears on multiple October 2025 best dividend stocks lists, offering a 3.09% to 3.3% yield, while trading 29% below fair value. The world's premier oilfield services company has carved out a narrow economic moat owing to its cost advantages and intangible assets. The company's distributions are considered shareholder-friendly, with management expected to return more than 70% of free cash flow to shareholders in dividends or buybacks. Schlumberger's partnership with NVIDIA to develop AI models is a promising differentiator for future growth. Now let me be completely honest with you about the risks, because no investment opportunity is without downsides. While dividend stocks offer relative stability, they are not immune to economic risks created by escalating trade wars. If tariffs lead to a recession, even defensive stocks will face headwinds from reduced consumer spending and corporate profit pressures. Caterpillar, a prominent blue-chip dividend stock, indicated it may incur costs amounting to $1.8 billion due to tariffs in fiscal 2025. The company's stock price declined 3.17% over a month preceding the report, and profit margins came under strain. While Caterpillar's long-standing reputation for resilience and consistent dividends remains intact, this example illustrates that even established dividend payers face real costs from trade restrictions. S&P Global Analysis notes that tariffs are set to have different impacts within industrial subsectors. In the freight and logistics sector, tariffs are expected to reduce volumes and pressure margins. Companies historically known for holding back dividend increases during market downturns might follow the same approach in 2025. As of October 17, 2025, Trump confirmed he will meet with President Xi but called the 100% tariff not sustainable, suggesting potential for negotiation. However, the uncertainty surrounding trade policy will likely persist, creating continued volatility. Many high-yielding dividend stocks, particularly REITs and utilities, are sensitive to interest rate movements. While the Federal Reserve has begun cutting rates, which generally benefits dividend stocks by making their yields more attractive relative to bonds, the trajectory of future rate policy remains uncertain. Trump's proposed policies, including tariffs and fiscal stimulus, could reignite inflationary pressures, potentially limiting the Fed's ability to cut rates aggressively. If inflation picks up again in 2025 primarily due to Trump's tariffs and their impact on goods and services prices, the Fed may pause or reverse its cutting cycle. This scenario would pressure rate-sensitive dividend stocks. Not all high-yielding stocks have sustainable dividends. The old adage, "don't chase yield," remains sound advice. Companies offering extremely high dividend yields, particularly those above 10%, often face genuine business challenges or unsustainable payout ratios. Mortgage REITs like Armor and Orchid Island Capital offer yields of 19% to 20%, but these come with significant risks, including book value volatility, interest rate sensitivity, and leverage concerns. BDCs with the highest yields often invest in riskier credits or use excessive leverage. Investors should focus on dividend sustainability metrics, including payout ratios below 70%, consistent free cash flow generation, manageable debt levels, and track records of maintaining or growing dividends through economic cycles. So here's my personal strategy for capitalizing on Trump's gift to dividend investors. I'm allocating 40% to Dividend Aristocrats with SCHD as my core holding because it provides instant diversification across 100 quality dividend growers with rock-bottom fees. Another 30% goes into energy infrastructure, split between Enterprise Products Partners and Enbridge, because these companies offer 6% to 7% yields with minimal tariff exposure and benefit from long-term secular trends in energy demand. I'm putting 20% into quality BDCs, specifically Main Street Capital and Blue Owl Capital Corporation, to capture those double-digit yields while maintaining focus on conservative lending practices and strong management teams. The final 10% I'm keeping for opportunistic investments in REITs like Realty Income and domestic winners like J.M. Smucker and Verizon that should benefit directly from Trump's policies. I'm dollar cost averaging this allocation over the next 3 months, rather than jumping in all at once because volatility will likely continue. I'm not betting on a market crash. I'm building a paycheck that arrives whether the market goes up, down, or sideways. The big picture here is that Trump's chaos has created a dividend investor's paradise. We have 3 distinct gifts. Safe haven flows into defensive quality stocks, irrational sell-offs of high-quality dividend payers with no actual tariff exposure, and specific sectors positioned to benefit from his policy agenda. The market will stay volatile, there's no question about that. But while traders panic over daily price swings, income investors collect checks. Dividends are tangible. They're real cash hitting your account every month or quarter. That's what makes this strategy so powerful during uncertain times. Trump didn't mean to hand us this gift. He was focused on his trade war with China, on bringing manufacturing back to America, on flexing American economic muscle. But the unintended consequence of his tariff threats was a massive rotation from overvalued growth stocks into undervalued dividend machines, and that rotation has created opportunities we haven't seen in years. So I want to know, which of these dividend stocks are you buying? Are you going with the safety of Dividend Aristocrats and SCHD? Are you chasing those higher yields in energy infrastructure or BDCS? Or are you betting on domestic beneficiaries of Trump's policies? Drop a comment below with your top dividend pick for October 2025. Enjoying the video? Smash that like button and subscribe for more smart investing insights every week. And remember, this is not financial advice. I'm sharing my personal investment strategy and the research I've done, but you need to do your own research and make decisions that fit your personal financial situation, risk tolerance, and investment goals. The best time to buy quality dividend stocks is when everyone else is selling. Trump didn't mean to hand us this gift, but I'm cashing in anyway.